Hello everyone, welcome to our webinar in 27th of December. This is one of the latest webinar for 2017. Before I start and welcome you everyone, can I have a quick feedback on the sound, please? If you have any audio or visual issue, just stick it in the box. Everything's okay. Thank you very much. Thank you very much. So, welcome to our webinar. Merry Christmas to everyone. If there are some people that celebrate Christmas, so Merry Christmas from me. I'm Andria Pichidi, a hot forex market analyst. And this is one of the last two webinars of 2017. We have another one tomorrow as well. So these guys, the last webinar of the year couldn't be something else, of course, than a review of the year. So today we'll go through the whole year in order to see the major events, either political ones, either fundamental ones, either economic data, either politics, environment, whatever affected the market and how it affected it. So that couldn't be something else than the review of the year as a last webinar for 2017. So before I start, I have to go through our usual disclaimer warning, of course. So this material is provided as a general marketing communication for informational purposes only. Nothing in this communication contains or should be considered as containing investment advice or an investment recommendation or a solicitation for the purpose of purchase or sale of any financial instrument. We make no representation and assume no liability as to the accuracy or completeness of any information provided, and we shall not be held liable for any loss arising from any investment made based on the information provided in this communication. This communication must not be reproduced or further distributed without our prior written permission. Risk warning: trading foreign and CFDs may not be suitable for all investors and carries a high degree of risk to your capital. Trading such products is risky and you may lose all of your invested capital. So I can see here that some people have a visual problem. Let me check something, Leois. I think let me switch on and switch off the sharing of the screen. If it's not fixed with what I have done right now, please restart the webinar. So let's continue. I'm Andria Pichidi, as I explained to you. I'm a market analyst here in Hot Forex. I have a 5-year study in UK, gaining a bachelor in mathematics and physics and a master's degree in mathematics and postgraduate diploma in actuarial science. My mission, and in general, our mission here in Hot Forex, and especially me and Stuart, is to help you becoming a better trader day after day. So by giving these webinars, by writing a daily market review every single day, by uploading those reports in the analysis website every day, is our way to help you understand the market and how the data or the news affected the market. So have a look in our analysis page. It will help you understand why we entered a position like that, what our view is, so you'll have a complete picture of the market. So it's good to read those reports, guys, because it will help you in your trading. It will help you becoming better day after day. So because it's quite a very, very big subject, the review of the year, I will quickly start. So we will emphasize, of course, in 2017 only. However, before I start I start with the 2017 events and how they affected each major currency and each major instrument one by one. We'll see, of course, the first thing that we'll see is US dollar and the common currency, which is euro, the last few years. So here I have a screenshot of a monthly euro dollar chart. So I have put this picture on since 2014 just to have a quick summary of what happened. So as you can see in this screenshot, the dollar rose against all other major currencies in 2014 for the first time since the turn of the century, and that was over here. So this was mainly due to the fact that the Federal Reserve, actually pointed out that we'll probably see a rise in interest rates during 2015, sorry. And that was actually what happened. So why this signal affected so much the euro dollar and drifted it lower from 1.5041 down to 1.03, I think. This is because the Fed signaled for a raise interest rate, while the other central banks, such as the European Central Bank and the Bank of Japan, were continued to keep taking an easy stance. So the euro and the yen as well fell 12%. That's a very, very big change. So both of them fell by 12% against the dollar. So dollar, we had seen in 2014 to 15 a strong dollar to do that signal by Fed that will raise raise the rates in 2015. So that was the major event that drifted the euro dollar lower, and that's why the USD became so strong against euro. So in 2015, however, we have seen, and 16, during these two periods, we have seen a consolidation of euro USD. However, again, dollar holds his gains. So these fluctuations in 2016, with a slight pickup of euro dollar, so we had a stronger euro up here. However, it drifted lower again due to the Paris attack in November, which ended the 2016 year at 1.08 again. So again at the near lows of 2018. Nevertheless, in 2016, we have again seen the fluctuation with the euro dollar picking up at 116. However, the Brexit vote, remember that we have seen United Kingdom voting to leave the European Union, that in June 25th of June, yeah, I think the 25th of June, that drifted again our instrument lower from the uptrend that we have seen in the start of 2016. So as you know, guys, the market is moving by the traders, by us. So back then, the traders traded based on the uncertainty of that vote. So by seeing that vote out of UK, by seeing the British people voting leaving EU, that caused uncertainty in Europe. That caused that actually give us the belief that European economy is going to weaken with this vote. So, however, in 2017, but also in the late 2016, and by I mean the late, it's up here, we have seen it indeed went lower. However, at that point, it holds its losses at above 1.05. So at this point onwards to 2017, we can see that the Brexit fear, the Brexit threat actually was quite calmer than before. So the markets calmed down after realizing that Brexit will actually take years to be done. So the markets had the Brexit in the background, and they weren't so worried about it. However, several key market indexes hit the series of new highs, fueled, of course, by the election of President Donald Trump out of US, and that gave also strength in dollar during this period here in the late of 2016, because President Donald Trump mentioned and suggested in his campaign that he will deliver business-friendly policies, including tax cuts and regulatory reductions as well. So this allowed the euro to rise to 1.16 in August. That was all for up to 2016. However, on today's webinar, of course, we will focus on the present and not on the past. So, as we can see, in 2017, we had a good recovery of the euro, because I've pointed out, I have put like on purpose actually here the Fibonacci level, because I wanted to show you that in 2017, so after 2 years time, we have seen finally euro dollar and actually euro recovering against dollar by 50%, nearly 50%. So that's recovered by 50%, by the halfway since the decline we have seen in 2015. Bushi, I have saw your question. Unfortunately, I cannot help you with that. Can you please contact support or your account manager? However, if you contact support, there are people upstairs that will help you immediately. So please send an email to them and they will help you as soon as possible. So yeah, they will give you all the details that you need. So let's continue. So what affected actually trading throughout 2017, and most precisely, let's start, of course, with the major markets, which are US, United States, and Europe. So after the strength, as I said, of USD dollar and the US in general, US markets, that we have seen that strength in the last quarter of 2016. Now, in the first quarter of 2017, we have seen that US equities performed well. And if I take into example the S&P 500, it advanced in the first quarter of 2017 by 6.1%. So the macroeconomics data have supported in the first quarter of 2017 the US. And how that happened? Because we have seen non-farm payrolls robust and activity indicators beyond. So this data, which also included manufacturing purchasing managers, the well-known to us the PMI index, and the Conference Board Consumer Confidence Index, rose to 125.6 in March, which is actually the highest. This is the one that I'm talking about. So we had seen the first quarter of 2017, as I have split it, our graph here to the 4 quarters of the year. So we are talking about the first quarter right now, which we see the dollar is there's falling on up to February, and then rising again until April. So what actually caused that is the fact that we have seen a robust non-farm payrolls, a very, very strong PMI, and an even stronger consumer confidence index, which actually was the highest in 16 years' time. So based on the improving outlook that we can see from the growth that we can see from the data, this data actually give a growth in the dollar in the US market, and that can be seen also from the peak that we have seen over here in our weekly US index. So based on that improving outlook of growth and based on the inflation, the Fed, the Federal Reserve, raised by 0.25% the rates at March. That's why we also see that peak in March up to 102.40. So we have seen that during the first quarter, we have seen Fed raising rates by 0.25%. So that was done on March. So this drifted lower the dollar index. Also, I have put here in these two tables given by Action Economics, actually, the whole performance from 2017 of the non-farm payrolls, which was a quite good year for jobs. So you can see that in this graph. And also, I put also employment releases from June to November for US employment as well. However, we'll see that in a while. But as you can see over here, if we have a good results in employment, so that helps or doesn't help the euro dollar. So you can see the correlation over here, what the result was, if it was a surprise or not, and how it affected euro dollar. However, we'll see that later on because we'll go through every single quarter for the major currencies. So, as I said, meanwhile, despite the Fed raised rates by 0.25% and the good data with CCI and PMI non-farm payrolls as well, the markets on the election of the President Donald Trump, the markets were very, very optimistic over this presidency. So because, as I said, Donald Trump was planning to cut taxes, boost infrastructure spending, and reduce also the regulatory burden on business. So the markets, the traders, and in general, everyone were very optimistic on this on President Trump administration. However, this wasn't last for too long, since there were some doubts on the administration ability to deliver what he said in his campaign, to deliver his policy agenda. Since we have seen a failure to repeal and replace the Affordable Care Act at the beginning, the first quarter, this was emphasized as well with the Republican majority in Congress not to be far away from united. So we have seen that, and that actually caused markets a doubt about Trump administration ability. So through all this political noise over the Trump's administration ability, what does seems clear at this point is that both U.S. consumer and business are significantly more important about the outlook that they were this time last year. So what the markets are focusing in the first quarter is of course U.S. consumer and businesses due to the President Trump failure of repeal and replace the Affordable Care Act. So the doubts on delivering its policy agenda. So, however, let's go. So as you can see in this slide, I have put up the Fed's rates during 2017 and the US consumer sentiment as given by Action Economics. So this is a very, very important data, guys. This is a very important these are quite important because they are affected they're affecting our markets. They're affecting especially dollar. They are affecting dollar, since as you can see in 2017 the initial rates by Fed was at 0.75%, and we have closed the year by a double rate. So during 2017 the Fed have double the interest rates, so that actually caused a lot of volatility in the market, a lot of fluctuations, and we ended up with a weaker dollar against euro and against yen in 2017. So some, let's say, of the major data that you have to take care of during the year, during your trading, is of course the rate rise, either from Fed, either from ECB, the European Central Bank, but for every single central bank in the world. That affects the market. Also the consumer sentiment and the confidence data, because they give whether an economy is strong or not, or is weak. So these are two of the basic data that you have to take care of. However, let's see a more precise chart of euro dollar, a daily one, split it again in the 4 quarters. So we have go through what happened the first quarter of euro, the first quarter for in US. However, what actually happened in euro? Why we have seen at the beginning of the first quarter dollar getting weaker against euro. Later on, the euro was weakened against dollar up to the end of February, and then he gained back all the losses that he faced during February. He gained back in March all the losses that it faced in February. So again, we ended up with an even stronger euro against dollar in the first quarter. So what actually happened? So in Europe, what was the main event that actually the major event that actually affected our currencies? Of course, the European Central Bank, and the fact that it kept rates steady. So we didn't have any change in the ECB interest rates. So this can be interpreted as a sign of higher the signs of higher inflation in combination, let's say, with an improving economic growth out of Europe. Strengthened the euro against the USD dollar and against the yen as well. So we had a strong euro because the data that we have seen in the first quarter of the year out of Europe were stronger, giving an improved economic growth out of Europe. So from the one hand, we have seen a rate rise from Fed, but a stable rates in Europe by ECB. We have seen in US good economic data, but the same happened in Euro as well. So in Europe, we had a 7.2% return in EMU index, of the Economic and Monetary Union. Also, we have seen the compromise purchasing manager index reaching the 6-year high at 56.7% in March. That's why we have that pick up that over here over February's fall. Sorry. And also CPI again. CPI was picked up to 2% in February, and while it slept back to 1.5% in March. So in Europe, the business service also showed that they have been rise to the highest levels over 5 years now, while the consumer confidence also recover close to the pre-crisis highs. This is significant, guys. The consumer confidence in Europe is close to the pre-crisis highs. So this was the most important signal of a Europe recovery after the crisis, because the data were close to the numbers that we have seen before the crisis in Europe. So this improvement in business confidence also all over Europe, Germany, France, Spain, all over Europe. Started actually showing that earnings were growing and that Europe has finally begun looking like a stronger economic bet. So that was the start for the first quarter of 2017. Also, you have seen the data over here. We have seen CPI, the consumer price index. As I said, these data are significant because they can give you a picture of the economy of each country. So here we have seen over 2017 the CPI out of Europe, or out of Eurozone in general, rising, giving a good signal of a stronger European economy. So let's go. Also, so this can also be seen by stocks. So as you can see, I on purpose put this DAX weekly chart because as we can see, even in the DAX index, in the German 30s index, this data, this this signal of a recovery in the Europe helped also European stocks to keep up with the US so far this year, so having underperformed last year, so give them a boost. However, what actually added so much volatility in the markets in the first quarter, and especially in the stocks, is of course the European elections, something that I haven't mentioned you up to now. We had a lot of European elections this year, and the first one was, of course, out of Austria, and Netherlands. So we had apologies. So we had elections. We have also European elections, which at the start rejected anti-European politicians, with the results in both Austria and Netherlands, which these actually show that that it is widely predicted over the Eurozone that the Eurozone is probably not as immune as some European politicians, let's say, believe. So we had in the Dutch election in March, which actually won by a center right. The name as actually won the anti-European party leader by Geert Wilders. So at the Dutch election, we have seen Europe winning again, despite the challenge out of anti-European parties, such as that also happened in Netherlands. Also in France, we had a French election between the pro-Euro Emmanuel Macron, but also the anti-European Le Pen. Also, we have seen a lot of elections. 2017. We had UK as well. We had Germany as well. That was sudden. That was some of them were quite sudden. Also, we have seen Japan as well. But let's focus on the first quarter. Sorry if I confused some of you. So, in the first quarter, as I said, we had a successful Dutch election in March with the center right to win. Then the eyes of all of us were in France, whether we had a competition, we had election, we had a competition, let's say, between Le Pen, which is which has an anti-Euro stance, and Emmanuel Macron, which was which actually was gaining a lot of confidence out of French people. So we have seen some polls actually suggesting that Emmanuel Macron will comfortably defeat Le Pen in the second round of the presidential election with 60% of the vote. So that was these elections and the outcomes of the polls actually boosted our stocks higher, and also boosted also euro, because we had a poll that was 60%. It was stating that 60% of the people will vote for pro-Euro Emmanuel Macron instead of anti-Euro Le Pen. So as you can see in the DAX index over here, the European stocks rally amid these signs of improving outlook for the global economy, despite the lot of political risks that we had at that point out of France, out of Netherlands, Austria, and also as the UK officially launched the 2-year process to remove itself from the European Union. So despite the good data, despite the election announced through first quarter, we also had UK that finally and officially mentioned that the Brexit will be a 2 years process, and that actually gave significant gains for stocks, while the euro was gained just 1% against the US dollar. So we had a quite mixed first quarter, as I said, with a lot of political uncertainty, which actually push euro lower. However, the good data and the fact that the Brexit, we had a deadline, we had a timeline for Brexit of 2 years, actually boost euro and end up with the first quarter being the euro being in a gain of 1% against the euro, the USD dollar in the first quarter of the year. So that was until April. So in the second quarter, of course, however, before I go through the second quarter, I want to take it one by one, and I will go through the first quarter of UK as well. So what happened in UK? The Theresa May also, as we just said, we had finally a timeline for the Brexit. So while the growth was improving across most of the world, we have seen good data out of US, good data out of Europe. However, the political uncertainty, the year actually starts with political uncertainty over Europe, and especially over UK economy, due to the Brexit vote on 26th of June 2016. So despite this Brexit vote, and while the Prime Minister Theresa May triggered Article 50 on Lisbon on March 2016, despite that, we have seen a boost in the FTSE 100 index by 4%, and we have seen evidence of a recovery in the global economy, but also in the UK economy. That was quite weird because we had a lot of uncertainty over UK economy due to Brexit. However, at the start of the first quarter, we have seen some signs of a strong UK economy. As you can see in this monthly chart over here, as we have already said, up to 2016, dollar was the gainer against all major currencies, and that was also presented in dollar in the cable graph. However, we have seen in 2017, despite the Brexit, despite the fact that Article 50 was triggered and the general political uncertainty for the UK, we have seen cable getting slightly stronger again against dollar. I have put over here the Fibonacci level since the vote. So since the vote, we are right now. I'm sorry, the vote was on June. That should be over here. So I suppose, okay, I put that up to 2016 peak and not up to the Brexit vote. So that was from the peak of 2016. So we are now again as the same thing that happened in euro dollar. However, here we can see that the cable and actually the pound recovered by more than 50% of the loss seen last year. So the cable is moving between 50 to 61.8% from last year's losses. However, let's see what actually caused this push higher. So as we said, despite all the uncertainty, we have a UK economy that proved to be stronger than expected, and mainly in the first quarter that happened due to a stronger than expected consumer spending following the leave, of course, the leave decision in the EU referendum. So that boost cable higher. Just imagine that the first quarter is from this point up to here. So we had this increase of nearly that's nearly 300 pips. Not sure about that, guys. Hopefully you can see this 1, 2, 3, 4 up this peak over here. So it was this, as I said, this boost of cable of pound was due to the fact that we have seen a strong consumer spending. Also, due to that, we have seen Bank of England upgraded its 2017 GDP growth from 1.4% to 2%. That also gives sterling strength over the period against the weaker US dollar, with the US dollar actually affected by President Trump failed to pass the revision to healthcare legislation. Meanwhile, we have seen Prime Minister Theresa May suggesting that the UK is hitting, let's say, towards a harder variant of Brexit, and as she set out the government's negotiation priorities in her speech in January. However, that didn't last for long. As you can see, in January we had a slight a lower performance for cable. However, the data push everything higher, along with the fact that President Trump failed to pass revisions to healthcare legislation. So let's continue with Japan, another major currency. So what happened in Japan in the first quarter of 2017? So after a very volatile 2016, the Japanese equity, as you will check, they were relatively calm, let's say, throughout the first quarter. That's because it was because we had some positive economic data and an improved global outlook, which was affected by political uncertainty overseas. As we said, in US there was political certainty to do the failure of Trump healthcare bill. Also in Europe there was a lot of elections and the Brexit that also caused uncertainty. So this along with the improved global outlook make the market, the Japanese market, relatively calm. So throughout the first quarter, the Japanese stocks register a total return in trading of just 0.6%. So after the sharp, as you can see, weakness of the yen at the end of 2016, the sharp weakness 2016, after that, the yen was appreciated and appreciated in the last 6 months of 2016. That was October, November, and December. And on 2017, as you can see over here, it was quite calm against dollar, and we have seen a consolidation between 38.2% and 61.8% recovery after the sharp weakness that we have seen in 2016. So from Japan's perspective, the main political event, the main event that actually affected the first quarter of the year for dollar yen was, of course, the meeting in February between Prime Minister Abe and President Trump in Washington and in Florida as well. So this meeting appeared to be, let's say, surprise, because despite the previous US rhetorics around the trade imbalance and the Japanese foreign exchange policy, so this meeting was actually itself a surprise for the market. So this meeting that actually caused a lot of volatility in the market, along with the decision, not actually a decision by the Liberal Democratic Party in early March to leave Prime Minister Abe continue to be a party leader for another term, actually push the yen lower. So the yen was becoming stronger against the dollar. However, meanwhile, what actually pushed yen stronger again in the first quarter against the dollar was also the corporate results for the last quarter until the mid-February, with the corporate results stating that 60% of the companies reported positive results, positive outcomes in compared to what is consensus. So the earning revisions were very, very strong and very, very positive in the early part of this year. So we had a lot of profit trends remaining in a favorable side, let's say. Also, we had business surveys indicating expansion in Japan, unemployment getting lower, down to 2.8%, and also a large part, let's say, of the reason for yen strength in the first quarter was also the upwards movement of US government bonds yields, and due to the fact that at the start of the 2017, the markets also faced Fed's raise highs, but also they had the anticipation of 2 more rate rise out of Feds for the rest of the year. This the combination of all these actually gave a strength to the yen against the weak dollar. So let's see what happened in the second quarter. Globally. Again, let's go through US, Euro, UK, and Japan. Oh my God, it's 46 minutes past. So, since we had signs of improvement in emerging markets and we have a synchronized, let's say, uptrend in global economic data out of every market, this good global economic data in combination with the uptrend for US dollar and the calm out of Brexit and the general good feeling for euro and more precisely for Europe recovery, we have seen in the second quarter the euro dollar rising up to 1.14. So we had a huge spike upwards in the second quarter. So the second quarter has been very positive for the euro as well, since we have seen investors enjoying a strong return in the first half of this year and a fantastic returns since the financial crisis in March 2009. That's not to say that we couldn't see some volatility in markets over the summer. Of course, we have seen some volatility, and since as you already know, the markets don't go up in a straight line. They have a pullback at some point in every single year. So what actually was the focus during the second quarter of 2017, the focus was at June, and of course at the June meeting of the Fed's committee, with the US Central Bank raised base rates by 25 basic points again, and while he announced also a quantitative tightening of the monetary policy. So this combined with an announcement as well of a reduction in the quantitative easing from ECB and a slowdown in Chinese growth in response to tightening there as well. So we had the focus was in the full focus in the first quarter was, of course, in central banks and on some key political developments. So we have we have a quantitative tightening from Feds, reduction of the quantitative easing out of ECB, and a slowdown in Chinese growth. So at the start of the quarter, we have seen an unexpected also, as I said, despite the central banks, we also had a key political developments. So what actually happened? At the start of the quarter, we will see unexpected elections out of UK and also elections in France. So by the end of the quarter, we had Marine Le Pen being rejected by France. So Emmanuel Macron elected as a president with a majority of the parliament. So that's an anti-euro rejection and a pro-euro won. So this political risk was the main focus. This political risk in France was the main focus in this quarter, with markets getting it as a positive, since this meant that the risk of Eurozone breakup was limited. So anti-euro Le Pen didn't won, so we didn't have the risk, let's say, that Europe will break up was gradually greatly diminished. So that was positive for the euro once again. So since the markets were anticipated for Emmanuel Macron victory, and they cheered on that, since he's a centrist leader, and he's committed to keep the France in Eurozone. So this based on these results out of French election, we have seen euro rally against the dollar by 7% on Macron's win, while the signs of a tightening monetary policy also boost Europe. Also, based on this, with the French election out of the agenda, Mario Draghi had a very maybe the most market moving speech for the events of that quarter, and he stated that the political winds are becoming tailwinds in Europe. So, and also stated that he cannot see a threat of deflation in Europe anymore, especially with some economic data, strong economic data out of Europe that quarter. So, as he importantly said, the ECB believes the force currently weighted on Euro's low inflation are temporarily, and as the economy continues to recover, a constant policy stance will become more accommodative. So the ECB thinks that what we are gaining from what he said is that the ECB thinks it will need to reduce its degree of stimulus just to keep the policy stance unchanged. So this reduction in monetary stimulus could continue to put pressure on government bonds markets over the next 12 years. However, as I said, we had a very strong economic data, giving again a better condition than in the last few years for Europe. So we have unemployment falling steadily, with only about 4% above the pre-crisis levels. Also had Eurozone consumer confidence, meanwhile, to be the highest since 2001. So this was giving a good the business to be unbeat, a strong economic outlook, manufacturing business to be high as well and positive, and might be the stronger since 2000. German IFO reached record highs as well, while the Eurozone annual inflation dipped to 1.3% in June from 1.4% in May. As I said, with ECB Draghi commenting that the threat of deflation is over. So that happened in May, and as you can in June, sorry. So you can see the three strong, very strong candles in June, in the last 3 days. If this is a daily chart, if I'm not wrong. Yes, so the last 3 days with this data coming out and the comments out of ECB Draghi commenting that the threat of deflation is over, boosted euro dollar up to 114, so even higher than what we have seen in May. So that was why we are stating that that the speech of Draghi might be one of the most market-moving events of that quarter. So, on the other hand, the U.S. economy also continues to look healthy. However, we had some mixed data. From the one hand, we have seen unemployment lower than what it has been 96% of the time since 1970. However, political uncertainty remains, and the focus is on Trump, with an important figure to be the dismiss by President Trump of the FBI Director James Comey. So this, the dismiss of the FBI, along with with the Fed's raised rates again in June, and the announcement that they will start reducing the size of the balance sheet, where negatively impacted dollars against the euro and against the major currencies. That's why we have a strong quarter for dollar. So sorry about that. So we have as per the UK, the UK, the strength and the stability of the UK government has been weakened since we have seen a sudden call of elections from Theresa May. So while we face the political uncertainty in Europe, this political uncertainty actually was reduced in Europe, but it was increased in UK since Theresa May called for snap elections. So, and that was for June 8th. So at the time, that time, this was widely anticipated back then, that the Conservatives would strengthen their majority and putting them on a stronger footing before the start of the Brexit. However, this was not actually happened, because in June the polls were narrow ahead of the UK general elections, and the sterling was weakened further on mixed economic data out of UK. So at the end, we'll see in the third quarter, we'll see May winning the election, however, with a minority of government. However, if we emphasize in the second quarter, many of the gains that we have seen in May, that was up to here, were undone in June, as also the polls were narrow ahead of the UK general elections. And on the back of some comments that we have seen from ECB Governor Mario Draghi and the Bank of England Mark Carney. So these were taken, let's say, these comments out of these two people were taken as a signal also of a shift towards tighter monetary policy. While remember that we have a further 25 basis points rise from Fed. So that signal of tightening monetary policy drifter cable lower. In the third quarter, on the one other half, the news for the Brexit negotiations continue to denominate around UK. So we have Brexit negotiations and Theresa May signaling in Florence that she wants a transitional deal between EU and UK. So this political outlook in the UK remains again highly uncertain. So don't forget, guys, Brexit is not done. So it was the worry during 2017 and will be up to 2020, which is the timeline given for Brexit. For Brexit to be actually done. However, in the third quarter, we have during that third quarter some signs of slowing of the UK economy to be slower down, while the inflation picked up, reaching the 2.9% in August. So during this quarter, the Bank of England was quite hawkish, actually more hawkish than what the market was anticipated, with a number of members of the Monetary Policy Committee discussing rate rise. So this occurred against a backdrop of the target inflation and the low unemployment, led the increase of the UK government bonds and yields and the rally in sterling against both the euro and the dollar. So the economic outlook was not so clear as we would like to be. So the low unemployment was, of course, a positive picture, and but again, the consumer confidence remained weak, and we had also some signs of weakness in the London housing market. So despite this highly uncertain backdrop, the Bank of England had made clear that they will think that an interest rate rise is warranted this year, with possibly more to come, let's say, in 2018. So sterling, as you can see, in the third quarter, strengthened a lot against the dollar. We have a very big rally up to 1.36, and this is, of course, on the Bank of England indication for a rates rise. So this appreciation, the currency was negatively weighted on the market, and the FTSE, which actually rose by 2.1%. As you will see, I have the FTSE over here. So while in the third quarter, and you can see that fall by 2% over at this area over here. So sorry, running out of steam. We have a lot to say. So as a summary, the third quarter grow during the third quarter. We had grow expectations for a rate rise by Bank of England and a transitional deal supporting the pound as well, despite, let's say, the poor performance that we have seen out of data. So what actually pushed the pound higher was the expectations of a rate rise of Bank of England and the transitional deal between EU and UK. So let's go back to the second and third quarter in Japan. So as you know, Japan is one of the top returning developed markets in the second quarter, and that was due to the political tensions globally wise and the more positive, let's say, outlook from the domestic economy. So the yen in the second quarter was weakened by 1% versus the dollar, the US dollar, and that provided support for some exporters. So after the weakening that we have seen in April, the Japanese market actually were higher by 6.8% at the end of the second quarter. So the Japanese currency, the yen, it is anyway a very volatile currency. However, the global uncertainty, as I said, remember elections in Europe, Trump administration ability was failing, a lot of geopolitics tension between North Korea and US. All of these were giving a boost to the Japanese yen, in combination with, of course, the Bank of Japan unchanged monetary policy and revised up its assessment of the economy using a more dovish, a more positive language than what he has done the last years. So all these give a boost to the currency. Also, we have seen Japanese government upgraded its assessment of the economy in its monthly report. So that was the first time this year in the second quarter. And the government was based on the improvement that they have seen in the consumer spending and the capital investment. So this improvement in consumer confidence, the improvement also in the gross domestic product, where along with the retail sales that were at the 7th straight month high that was up to May indicate a good Japanese economy. So nevertheless, also the evidence of the quarterly Tangan survey also indicated that we had a growing confidence among the Japanese corporates. So despite this relatively positive backdrop, an improvement in equity market sentiment was also constrained by geopolitical events, as I said, and more precisely the significant escalation in tensions around North Korea, in which there was no sign of what actually will happen and how and when these tensions will stop. In the third let's go back to the third and fourth third and fourth quarter for Europe and US. So I will not repeat myself and say that the global economy continued to be healthier and healthier quarter after quarter. So we had US in the last two quarters, and especially in the third quarter, we had job vacancies hitting the highest level since 2000. However, some other good, strong, positive data was also the economy that actually I'm sorry. However, as I said, the data were continued to give some strength on dollar, but that was taken back due to the tensions rising between North Korea and the failure of Trump administration to realize its policy. So despite the data, we have seen a weakness in the dollar. Also, despite the tensions and the failure of Trump, we have the Hurricane Harvey and Irma, which so in the wake, let's say, of Hurricane Harvey and Irma, the economic data and the forward-looking activity indicators deteriorated towards the period end. So the markets judged that any potential negative impact of growth would be transitory, as the Fed in this statement following the latest Federal Open Market Committee meeting. So a lot of things in the third quarter push dollar lower, so we have a further weakness in dollar. As I said, tensions of North Korea, failure of the President administration, the Hurricane Harvey and Irma that impacted the U.S. economic data, while also the FOMC statement confirmed that measures to reduce its balance sheet will begin in October, despite the weak inflation. So this upbeat tone of the report and the press conference by Chairman President Yellen added expectation of an increased rates this year's another increase in US interest rates this year. So all this anticipation was weakening the US dollar. From the other hand, Eurozone European equities were up in a modest advance in the third quarter. Economic data remain robust, especially in the last 3 months. So we had GDP confirming at 0.6. The Economic Commission economic sentiment indicator rising at the highest level since July 2007. Unemployment in the Eurozone remaining stable. but stable in comparison to July, but lowest rate since February 2009. But despite the good data, again, the focus was on ECB, with the President Draghi discussing several scenarios regarding the quantitative easing program. So the expectation of the market of a tighter monetary policy was pushing the euro for the most of the period. That was the main event that actually pushed the euro stronger and becoming stronger and stronger during the third quarter. This, along with, of course, the ECB, as I said, it was the main driver of euro. We also had in the late September a weaker than expected performance of Angela Merkel in the German elections. However, what actually affected the euro becoming stronger in against dollar was the ECB prospect of a tightening monetary policy that was pushing euro higher. However, during the fourth quarter, it was for granted that eurozone is continuing its better than expected growth. So again, from the one hand, we have euro with GDP getting higher, unemployment rate falling at 8 years low at 8.9. However, what actually the big monetary policy of the month was of, again, the European Central Bank's October meeting with the Mario Draghi. Sorry, apologies for that. With Mario Draghi again finally announcing actually that the quantitative easing will be extended to September 2018. But the base of purchases will be reduced from 60 billion per month to 30 billion. So this was an acknowledgement, let's say, of the solid growth that keeps the door open for a further extension to be announced in 2018. So this was an unexpected. It was expected from ECB. We were expected for a quantitative for an extension of the quantitative easing in 2018. So from the eurozone, we have the ECB extending the quantitative easing for another 9 months, while on the other hand, we have Catalonian holding a referendum of independence on 1st of October. That was increasing again the political uncertainty over Europe, with Catalan parliament unilaterally declare independence from Spain after a secret vote, and that also triggered Article 50 by the Spanish 155 by the Spanish authority. That, as you can see in the graph, push the euro, weakens the euro during the early part of the fourth quarter. So we had the slight drift lower for the euro down to 155.90. However, on the other hand, we have the US stating a better than expected third quarter GDP, while the spending, the hurricane of Harvey and Irma push the spendings stronger and higher. So we had some good outcomes out of the hurricanes, of both hurricanes. Consumer sentiment was beyond, with the Conference Board Consumer Confidence Index surpassing the peak it achieved at the start of the 2017, while the strong data continue with, of course, unemployment falling further, with September's reading dropping to 4.2%. Non-farm payrolls dipped significantly. The non-farm payrolls are significant, guys, and that's why I put them in the first slide at the initial of this webinar. So the non-farm payrolls in September showed that there were 33,000 fewer jobs for this month in compared to August. However, later on, we have, if I'm not wrong, let me check. Sorry. Up. Sorry, apologies for that. I mixed my slides. So we had 33,000 jobs fewer than August. However, in November, we had 261,000 jobs added in October, and 228,000 jobs in November. So jobs, more and more jobs were created in US, so that boost dollar slightly against euro. Also, we have seen, if you check the fourth quarter, this boost lower was also due to the fact that we have seen some Trump administration making some progress in Senate with its proposed tax reform. And more precisely, in November, we have seen the Trump administration proposed tax proposal taking a step closer to approval in November, which he actually managed to do it in December. So the tax bill was approved by House and Senate in December. And that was the boost lower that you can see in the strength of the dollar. So we have, for the first time, the Trump administration managed to achieve one of the things that he has in his policy agenda. That was significant achievement for Donald Trump. Also, we had a rate hike in December up to 1.50%. That's closer to the target of 2%. And as I said, a very, very good employment data. So this gave some gains for dollar. However, this was taken back since Eurozone continues to provide some strong signals of recovery. So we have seen manufacturing PMIs rising, trade surplus out of euro, German IFO continued to record highs, industrial production up, retail sales as well, and unemployment declining in Eurozone as well. So I will quickly cover also, because we are way out of time, I will try to quickly cover the fourth quarter of UK and the third and fourth quarter of Japan, and I have also oil at the end of the of my presentation. So the third quarter in Japan was a good quarter for markets in general. However, in Japan, we have seen again more jobs available per applicant than at any point since 1974. So after this moving sideways in July and August, as you can see over here, we had this sideways movement. The Japanese market rose in September to a record of a gain of 4.7% of the quarter. As you can see, dollar in the third quarter, yen was getting stronger against dollar, and in general, the Japanese markets were rising and rising. The political events that was the political events was what actually moved rapidly the market. So we had that quarter starting with a defeat from the LDP in the Tokyo Assembly elections at the hands of the Governor Koike, but ended with Prime Minister Abe calling for a snap election to be held in late October. That actually just confirm. Actually, Prime Minister Abe wanted to take advantage of this. Actually, called for an election because he wanted to rebound his personal popularity. So that snap elections, however, push the yen. The dollar yen higher, so we have seen some weakness of yen against dollar the last 2 weeks of the third quarter. However, the economic data continued to improve. So Japan's economy expanded at the 2.5% rate in the third quarter. That was the fastest expansion in more than 2 years for Japan. So this along with the low than expected business investment and the industrial production being better than forecast, inflation jumping in with the CPI rising by 0.7, and the Bank of Japan releasing a survey which present a further improvement in business that actually helped that drift lower in the third quarter, and we have in the third quarter for yen, that push of yen. Meanwhile, during the third quarter, the Bank of Japan left interest rates unchanged. So despite the signs of economic growth and the higher inflation. So in the currencies, the US dollar remained flat against the yen. So you can see the general trend. We have seen a flat yen against the dollars, pivoting around 1.1174. So it getting down, up, but also pivoting, but all the time pivoting around that level. So we cannot claim for a strong yen against dollar during 2017, but for a flat yen against 2017. For a flat yen against USD during 2017. As per the last quarter, we had the elections in focus. So as expected, the voters handed the majority to the Japanese Prime Minister Abe, winning the snap elections. So during the campaign, the Prime Minister Abe made some promises such as fiscal policy to voters, including part of the revenue from the upcoming consumption tax hikes to increase the labor forex participation and to invest in improving Japan's human capital. While the data-wise, Japan again in October and November faced a strong rally, which took actually the market to the highest level seen in 2016 before the sharp reversal in November. So there was a further weakness in the correlation between equity market and the currency. So the yen was generally stronger during the October and November. with CPI high, labor market data suggesting Japan is operating close to full employment, and the GDP figures to be released as well. However, on the other hand, the North Korea geopolitical risk to be a further long range, along with a missile test be done in the last quarter. So that actually despite all this positive data and despite the election for the Abiy, Prime Minister Abiy elected again with a majority, we have seen dollar gaining some ground out of yen, since finally, as we said, the Trump administration managed to had a win on the U.S. tax bill, since U.S. tax bill was approved by the House and the Senate in December. That was the first win for President Trump. And on the other hand, we have seen Fed raised rates by 0.25%. So we have seen the Fed hitting the 1.50% rates hike, that is closer to their targets. And that was done by Japan. What I'm missing, guys? So what I left behind, I think, is the last quarter of no, that's covered as well. So because we are half an hour above our time frame, I will quickly give some commodities review, and that's in oil. I have put it in. I have put weekly oil and dollar CAD, because, as you know, CAD, Canadian dollar, and oil are correlated a lot. Correlated. Positively. So what happened in US oil during 2018? So oil, we have seen in generally the first quarter of 2017, we have seen a large decline in the energy component in general. More precisely, we have seen oil falling by 7%, since we had oil inventories and production out of US increased in a faster rate than expected. Due to that oil inventories and the faster rate than expected, we also have seen gas getting lower by negative 14% as well. Meanwhile, in the second quarter, the energy was again the weakest component, as the oil fell by 9.3%. This was done mainly due to OPEC, and due to the fact that OPEC members and other producer nations extended production cuts. But this was not the thing that actually dipped the market. But these were not as deep as the market had anticipated. So the weakness was exaggerated by rising US products as well, by the rising US production. So from the one hand, we have OPEC members and non-members extended production cuts. On the other hand, we have a rising US production. On the third and fourth quarter, we have a positive picture for US oil, especially in the third quarter, since the energy was the top performing sector, with oil prices edging higher over the quarter. So in general, we have seen the materials and information technology being the top performing sectors, while the healthcare was the only one to register a negative return from the quarter. However, since we are talking about oil, as I said, was the top performer sector, so the oil rallied by 20% over that quarter. That was supported by the faster than expected fall in the US oil inventories and the increased expectation for an extension of production cuts amid the rising global demand. While on the last quarter, the oil and the gas sector outperformed the wider market against the backdrop of rising crude oil prices and encouraging corporate results. So the oil prices were firmer, and that was as a result of a backdrop from the global demand, and of course after the OPEC-led production cuts were extended until the end of the 2018. That caused the US oil hitting the nearly the 60, 50, $59 per barrel in the late of the fourth quarter. That extension until the end of 2018 of production cuts by OPEC. I'm sorry if I had a lot to cover, so I'm sorry if I was speaking too fast. Hopefully I helped you with this webinar. Since we ran out of time, and if you have any question, anything that you want to ask, unfortunately you have to send it via email to our webinar at hotforex.com. Here in this email, it's me and Stuart that we are replying. So please, because this was a huge webinar, if you have any question, please send it to us and I will reply to you as soon as possible. So thank you very much for watching. I appreciate the 20 people that stay up to now to watch the full webinar. Hopefully I help you to understand what actually moves the market, what data, what news you have to take care of. I wanted to wish you a happy new year, since I will be off, and hopefully we'll speak again in early January. Have a great New Year's Eve, everyone. If you have any question, as I said, send it to us. I will reply as soon as possible. And again, thank you for watching. Have a great trading day. And remember, as Stuart is saying, this week is a week full of opportunities, since we have a limitation of the data, and also December is traditionally is a very good month for full of opportunities, and traditionally a bullish stocks market month. So take care for opportunities. Have a wonderful trading day, and see you all in the new year. Bye bye.